news coming in. March inflation numbers are out at 6.95% versus 6.07% in February, largely led by the food inflation, which has also seen a spike, gone up to 7.68% as well. Now, remember, this is more than the RBI, the Reserve Bank of India's comfort zone as well, as far as inflation is concerned. Let me bring in some perspective here. Sakshi Gupta, senior economist at HDFC, is joining us on the broadcast. Thank you so much for speaking to us. Your reaction to these numbers, well ahead of RBI's comfort zone. This was in some way expected, but this still doesn't encompass the entire increase in oil prices that we've seen so far.
Absolutely. Thank you, first of all, for having me on this show. This print is definitely a shocker. We were expecting inflation to be around 6.3, 6.4. And the fact is that this is just, a week and a half of pass-through of higher petrol and diesel prices, because we have to remember that for most of March, fuel prices, remain unchanged. So, going ahead for the coming months, at least in the near term, it means that we could see inflation rising above 7%. April is going to be the first print which will have the full impact. The problem really on inflation now is not just, rising the petrol and diesel prices, LNG or CNG prices, fuel prices as a whole, but the second round impact that feeds into, food, the food basket, which is so important, for in overall consumer, spending. So we are going to be seeing huge pressure coming in on the food side as well, and that's already started playing out. That's visible in this print. We are seeing a rise in oils and fats, vegetable prices. So I think this is a big problem. Yes, the RBI recently in its policy meeting last week has turned the corner, was slightly more hawkish than its last policy, and has recognized the fact that inflation is a problem because they've increased their inflation forecast for FY23.
Yes.
I think this print would perhaps nudge the RBI now to change its stance from accommodative to neutral in the coming policy and pave the way for a repo rate hike. Perhaps before, I earlier forecast was August, but perhaps we are looking at a rate hike even before August.
All right. Stay with us, Sakshi. Let me also go across to Madan Sabnavis, who's joining us as well. Thank you so much for speaking to us. Your view then, do you think that we are likely to, now that, inflation numbers have come in at this level, possibly going to go up more, at least in the next policy, do you then expect the RBI to hike rates?
No, absolutely. I think next policy is the time when the interest rate, the repo rate will be hiked, because if you look at the RBI's quarterly forecast which they have given, it's the highest for the first quarter. So normally you increase the rates when you already see a high inflation number. And given the fact it's going to be above 6% in the April to June quarter, there is a very strong justification for increasing the rates. So I don't think it will be a two-step approach of first changing the stance and then increasing the repo rate. It will probably be jumping to the repo rate directly. Because the way in which inflation is proceeding right now, it looks fairly prodigious. It's almost broad-based. I think almost every category of commodity has shown high inflation, much higher than what we had expected for the month of March.
Yes, absolutely. Sakshi, the other question then would be at this point, given the rise in inflation, and we've been covering it here as well, across the board, essential products all seeing a rise, pinching, the common man's pocket. How do you see the demand factor then playing out going ahead? Because that was just starting to come back after the entire COVID impact. Do you see a dent in that aspect going forward?
It really depends on how long this inflationary pressure continues for, right? If this is something that the RBI and the government can get in control and prevent from inflation expectations rising, the impact could be lower. But if inflationary pressures become entrenched in the system and you see, the prints, printing above 6% for a number of months, then I think we are looking at a severe problem on the consumption side. Already, I think the consumption pickup that you spoke about is not broad-based. So it is coming from certain segments. But you have the, some segments of households that have still not recovered to pre-pandemic levels. So it's a very fragmented recovery at the best right now. And, higher inflation for a long period of time, especially in things like food, is, going to pull down household spending and consumption.
Yes, absolutely. Mrs. Sabnavis, to you then, how worried would you be in terms of the long-term impact that this level of inflation will have, which we might see rising further, given that we had seen a good bout of recovery sort of coming in? Do you fear that there might be some undoing of some of the good that we've done with respect to the economy?
In fact, we have seen in the past also that whenever inflation remains high on a sustained basis, there is a tendency to come in the way of demand, because we need to distinguish between necessities and non-necessities. When I talk of necessities, we're talking of food. As we keep spending more on food items, there would be less money left for savings and discretionary consumption. And what we have seen is that from October 2021 onwards, there's been a tendency for a number of manufacturing companies in the consumer goods area to pass on the higher input costs to the consumer. So this process had already begun. Now I think it's only going to accelerate with the second round of inflation which we're seeing. So I would tend to believe that maybe in another couple of quarters, this will actually get manifested in terms of lower demand, especially consumer goods.
All right, we leave it there. Madan Sabnavis, Sakshi, thank you so much for joining us with your perspective on the inflation numbers.